6 types of alternative funding you need to know about to fund your business. Look, if you're trying to get money from your bank to fund your business, you're doing it all wrong, because it's way easier and faster to get money through these 6 alternative ways that you can easily tap into to be able to fund your business. So that's exactly what I'm going to decode today. I'm going to show you 6 of my favorite alternative ways to fund your business other than the big banks, how these programs work, how to get approved, and everything else you need to know to leave this training and actually go get funding for your business. So let's dive in. So 6 different alternative types of ways to fund your business. So let's look at how lenders lend to businesses and what's different about these 6 alternatives. First of all, banks are looking at everything to do with you and your business. And what it means is that they're looking at your tax returns. They're looking at your P&Ls. They're looking at your bank statements. They're looking at the credit of the business. They're looking at your personal credit, your personal bank statements, your personal tax returns. They're looking at every aspect of you and your business. Now, when you're really well established, you have good personal credit, good business credit, that might be okay. Meaning, if you've been in business for years, your financials are strong, personal business, your credit's strong, personal business, then that is when you want to go start talking to banks about getting loans and credit lines. But until you're to that point, banks are the wrong place for you to look to get funding, because they're looking at everything and you probably are not going to meet their requirements. You probably aren't going to have 3 years of business tax returns. You're probably not going to show profit on your tax returns and have well-established business credit and all the other stuff that these banks need, that quite honestly might be a little insane that they even need us to get us approved. Now we look at alternative lenders. These alternative lenders are the exact opposite. First of all, they're not looking at both you and your business. They're only looking at one aspect of either you or your business. And I'll explain what I mean. So, for example, some of them are just looking at consumer credit quality. And if you just have good consumer credit or a guarantor that does, you can get funding. Others are just looking at the revenue of the business. If your business has consistent revenue for 6 months or more, that's all they care about seeing. And others are just looking at like some kind of asset, that you can serve as collateral. We'll go over many of those options today. But if you have one of those 3, you don't need the other 2. That means if you have good personal credit, you don't need revenue, and you don't need good business credit, and you don't need collateral and all the other stuff that these big banks need. But if you just have, for example, revenue or personal credit or some kind of collateral, you don't need the others. You just need one of these. So as a result of only needing one of these strengths, it's way easier to get this money than any other kind of money that's out there. So let's dive into my 6 of my favorite alternative ways to fund your business, starting with number 1, my personal favorite. It's called credit line hybrid. So with credit line hybrid, it's also known as sometimes credit stacking or credit card stacking. And what ultimately is happening is the financial source is going out, and they're going out to find the best credit lines for you. They're getting them all at the same time. And the result of that is way more funding than you would get on your own, or if they're just applying for you in one place at one time. By the way, if you're just coming in, give me your company name and I'll give you a shout out right here on the live stream. So a credit line hybrid, you're getting up to $150,000 in funding. Now you usually get about 5 times the amount of whatever your highest major credit card limit is now. So if my major credit card is $10,000, I get about 5 times that, or about 100 or 50 grand, right? If it's $10,000, if it's $20,000, I can get 100 grand. So whatever my highest credit card is, Chase, Bank of America, whatever, on my consumer credit report, with credit line hybrid, you get about 5 times the amount of that funding, of that limit. So if you get in limit of 20 grand, you get 100 grand with this program, for example. Now, this is a no-doc program. They're not looking at tax returns, P&Ls, balance statements, bank statements. There's basically no income docs you need besides just like verifying your identity. They'll probably ask for like a driver's license. And Merle says, hey, what's up? Thanks for coming in, Sweet Catering. Absolutely. Merle, you can email me direct at info@creditsuite.com so we can figure out what it is you need and help you get credit funding for your business. So credit line hybrid, $50,000, $100,000, $150,000 in funding. Typically, you're going to get about $150,000 in funding the first 6 months. You can get more funding after that. A lot of our clients end up asking for limit increases, and within a 12-month time period, the funding they get doubles. So a lot of them start with $100,000 and they end up getting, $200,000, for example, within a year later. Now, this program, as I said, is no doc. They don't look at income docs. All they care about is personal credit score. You need about a score of about 680 or higher in order to get approved. And even if you don't have that, you can use a family member's credit, a friend's credit, a potential investor, somebody else's credit to actually be able to come in and get approved. So you can use a guarantor instead of your credit if your credit's damaged. So by the way, half of the clients we help fund on this program are using somebody else's credit in order to actually come in and get approved. Now, they do care about inquiries. They want about less than 6 inquiries in the last 6 months in your consumer credit report. If you have more than that, well, then you're probably just going to get a little less funding because of your increased inquiries. They also care about utilization. So they're going to want you to be below 40, preferably 30% of the limits on your consumer credit cards. But that's it. If you have good credit, low inquiries, and good utilization, you're probably going to qualify for 50, 100, or 150,000 of this program. Fantastic for startups, the best program I've ever found. Fantastic for real estate investors, the best I've ever found, because you can take the cash out of these lines at 0% interest. So a lot of these credit lines are 0%. They report to the business credit reporting agencies. So a lot of them will help you build business credit, and you get 0% financing. Plus, you could pull the cash out of these lines at 0%. So you could literally get $150,000 with 0% rates for up to 18 months. It's why industries like real estate investors love this so much, because you can literally get these lines, pull the cash out, buy a home, flip the home, do it again and again. And within 18 months, you've made so much money, you could probably buy your future homes from that point with cash, right? With the cash that you made. This is where the BRRRR method of real estate investing comes in. It's primarily driven based on this program to start the very first process of buying that home, right? Then you can come in, you can rehab, and you can refinance and rent it and repeat. Well, the first step is to buy the home. Well, this is oftentimes the type of financing that clients are using to do that. And Terrio says, hey, Ty, you're awesome. I appreciate that. You don't get the credit you deserve. Thank you, man. I love you too. Been a client of yours for 5 years now. Much respect for your effort and pioneering in the industry. I really appreciate that. It's so cool. I interviewed a guy earlier today on my podcast, and he's newer into the credit card stacking space. Or not newer, but has been in there for a matter of the last handful plus years. And he talks about my influence in the industry. It's just interesting to see these new kids coming in and killing it in the business credit and financing space. I've been here for a bit now. So thank you very much. I appreciate that. That really, really, really cool comment. And Terrio, thanks for joining. Okay, so number 5, we'll go frontwards, not backwards. Number 2 types of alternative financing you can see here. It is, we are in the middle of a thunderstorm here in downtown Tampa. So number 1, credit line hybrid, right? Love it. No doc, startup. Perfect for startups, $150,000 in funding. I love that program for so many reasons. Number 2 is called cash flow financing. This one, as you could probably surmise, comes with you having cash flow. Now, if you have cash flow for 6 months, you can get funding using this program. Your personal credit does not matter. You do not need any collateral or asset. I mean, there's lenders here that have no credit score requirements. Even if your credit score was 360, you could still get approved for this funding program as long as you have 6 months worth of consistent revenue and as long as you are managing your bank accounts responsibly. What that means is, like, you don't have non-sufficient funds. You have positive ending bank balance at the end of each month. You have more money coming in than actually going out. Okay, you're not overdrawing the bank account. If you have a bank account for 6 months for your business and you're managing it responsibly, then you can get this kind of financing. Now, you could typically get up to $500,000, $500,000 in funding using this program. How much you get approved for depends on your revenue. You can usually get about 15% of whatever your annual revenue is. So figure out what your annual revenue is. You can get about 15% of that lent on this program. Fast funding. I mean, you can usually get money in your bank account in 72 hours or less, just by a simple bank statement review. It's one of the fastest, easiest ways I've ever seen to fund a business. If you have about $10,000 a month in revenue, then more than likely you're going to qualify. Again, if you're managing that bank account responsibly. That brings me to the number 3 of my 6 best alternative ways to fund your business, and that is MCAs, otherwise known as merchant cash advances. Now, merchant cash advances work really similar to revenue lending. They don't care about your credit score. They don't care about your collateral. All they care about is how much money is going into your bank from credit card transactions. So revenue lending, they're looking at all deposits into your bank account, checks, cash, credit cards. With merchant cash advances, they're only looking at credit card deposits into your bank account. They're going to look at how much you deposit credit card transactions. You're going to be lent about as much as 15% of whatever the total of those deposits are. Now, with this program, you only need $5,000 a month in revenue and 6 months' time in business in order to get approved. Again, very fast money. 72 hours or later, you're funded. Very easy money. All they care about is the money going in the bank account and bank account management. They do not care about collateral. They do not care about credit either. Now, that brings me to funding 4, option number 4 of my 6 favorite alternative lending products. And this is invoice financing or invoice factoring. Look, I'm going to kind of roll in a few different ways to fund your business into this. One is like invoice financing. So if you have invoices, meaning that if you let customers pay you on terms, then this qualifies for this kind of financing. It's called factoring. It's called invoice financing. It's called AR financing. And basically, this is where you let your customers pay you over time, but because they owe you that money, that becomes an asset to the business that helps you get that money advanced by a lender right away. So let me give you an example. Let's say I'm selling a $2,000 product and I give somebody 9 months to pay me back, to pay me that $2,000. Well, normally I would have to get a little bit of money from them every month, which is convenient for them because they can afford to buy from me. But it's not convenient for me because I got to get my $2,000 over 9 months instead of all at once. Well, AR financing fixes that problem. It allows our customers to pay over time, but the lender gives us like 90% of the money right away, 24 hours later. So my customer starts making small payments to pay off that $2,000, and the lender gives me 90% of that $2,000, $1,800 the next day, even though the customer's going to pay it over 9 months. You see the benefit? First benefit, your clients can pay you over time. So this helps you attract more customers because they can pay you over time. And the big benefit is that you get most of that money right away within 24 hours. So it's convenient to attract more customers and convenient for you because you're getting the majority of your money right away. Plus, the factoring rate on this is very small, like 1.5%. So if the money's not outstanding for a long period of time, it doesn't cost a lot of money to be able to qualify for this program. They do not care about credit scores. They don't even look at your personal credit. They do not care about your cash flow either. All they care about is like the receivables. They get like an aged inventory or an aged receivables report, and they look at like the people paying you. And if the people paying you or that you're giving credit to are credit worthy, like their business credit doesn't suck, then there's a good possibility you can get approved regardless of credit, regardless of cash flow. Now, if you're not doing this already, start doing it. Let your customers pay you on terms. Start building an asset for your business. Leverage that to get AR financing. And by the way, as you let your customers pay you on terms and you accrue more account receivables, that is the number 1 asset used to qualify for SBA loans. Number 1. So just by doing this, this already puts you on an advanced path to be able to start getting SBA loans down the road. That brings me to number 5 best way to fund your business. This one doesn't get enough attention. Micro loans. Look, micro loans, a lot of business owners don't know about because banks don't offer them because banks don't make enough money to offer them. So they're offered through all these other obscure places. So most entrepreneurs don't hear about them enough to be familiar, but you should be because micro loans go up to $50,000 and they work great for newer businesses. Like you can come in with average credit, be a newer business, and still qualify for microloans for a lot of different places. Now, Kiva is one of those places that you could check into. And the best place for this are SBA intermediaries. So SBA intermediaries are like nonprofit organizations that help you through the process of getting these microloans from SBA. An average micro loan from SBA is about $13,000. And it oftentimes, again, works really well for startups. So you can go Google SBA microloans, and you'll go to SBA's website where they give you a list of intermediaries in your state. And then you can go to these intermediaries. I can't say intermediaries. I can't say it 3 times fast. I don't know if you can. Intermediaries, it's taken me a long time to be able to say it 1 time, let alone 3 times fast. These intermediaries can then help you get the funding in that state. Now, you can do some research on microloans. There's a lot of different types of microloans out there, with Kiva being one of the most popular. But again, SBA microloans account for the vast majority of micro lending takes place. And the last, number 6, I don't even talk about this enough. Not enough people are discussing this: business grants. Well, this is free money, 100% free money you can get to be able to launch or grow your business. And it comes from numerous different sources. Grants come from the federal government. They come from local communities, counties. They come from your state. And they also come from like private organizations, right? So there's a lot of different organizations out there, like trusts, that actually create these kind of funds that fund grants for people in their industry or sector. So first of all, is grants being free? It sounds too good to be true, but it's not. If you think about it, here's the thing to know about grants. Grants incentivize something. Now, typically, they incentivize one of 2 things. They incentivize growth in an industry or region. So, for example, where I'm from in Indiana, they have all these big windmills now, these wind turbines that generate power, right? Because Indiana's flat, so there's a lot of wind. Now, this wasn't there when I grew up. It's now there many decades later. I don't want to age myself, but I will tell you that these wind turbines are very popular in the state of Indiana. Well, they're popular because Indiana put all this grant money out to these companies to put these turbines in the state. They incentivize that industry to come to their state and do what they want them to do. We see these kind of tax breaks and incentive when Amazon's throwing up a new headquarters, right? Everybody's competing for that headquarters because they want those jobs in their area. So the state will make all kinds of concessions and issue grants, so they make it very feasible for Amazon to come in and build that facility. So, for example, these grants are incentivizing growth in an industry. One area, one state may want a lot of growth of one industry there, so they incentivize through grants for industries to want to come in there. Now, they're also incentivizing based on a geographic area. So, for example, USDA is dealing with rural areas, right? Okay, so because of that, they want you to actually come in. They want to incentivize growth in these areas that don't usually have like a lot of businesses there. Because when businesses come in, they need employees, and that brings more people in, and that pays them more taxes, right? So if we look at USDA, if we look at these rural housing, for example, or urban, there's incentives and grants that incentivize growth in an urban area, or incentivize grant in a rural area. That's why they exist. So the incentivizing of an area or an industry is one of the things that grants are primarily there to do. Incentivize growth of an industry in an area, or just incentivize business growth in an area. Now, the second thing is to serve underserved audiences, women entrepreneur, African-American business owners, for example, veteran business owners, disabled veteran business owners. There's a lot of these underserved demographics where statistics show it's very hard for them to get money. Like compared to business owners that are not in these underserved demographics, they really struggle to get the financing they need to be able to start and grow their business. So grants incentivize those underserved industries. So this is why you'll find a lot of grants out there just for African-American entrepreneurs, or just for women entrepreneurs, or just for African-American women entrepreneurs, for example. So if you are in an underserved demographic, there's a good probability you're going to find grants that are fairly easy to get just for you to incentivize your ability to be able to get in and launch and grow businesses. So grants, primarily are designed to incentivize growth in an area or an industry or both. And they're also designed to be able to get funding in the hands of underserved audiences to be able to make it easier for them to start and launch businesses. So the easiest way to think about this is go to look at federal grants, state grants, local grants. The best place for federal grants, grants.gov. This is the #1 source of grants across all grants. There's thousands of them there. You can go through numerous different searches to actually be able to find the right grant for you. For state and local grants, you want to look at Grant Watch. Grant Watch is the best provider of local grants that you can actually get, where again, you come in, there's all kinds of search criteria, and you can find the right grants for you there as well. We also have a great guide on, or a whole course for grants, but I don't know where it's located. I should probably know that before I promote it. Wait a minute, maybe it's on my little sheet, but next time I will find that out for you so we can actually tee that up for you as well. Now, Christine says, hey, CFO events from in of the Houston area. We're about to launch a niche company under the above mentioned parent company. We decided to call our purpose-driven, small and mighty company Comfort Shadow. I love that, Christine. Congratulations on your upcoming success. I love the business name, by the way. I think that is super, super cool. So there you have it. There are my 6 different alternative ways to fund your business. #1, credit line hybrid, perfect for startups, no doc funding, up to $150,000 with 0% rates, and helps you build business credit. If you're interested in that, you can go to creditsuite.com/CLH, and there's a shortcut to get approved. #2, cash flow financing. This is where you can get financing just based on the cash flow of your business. You don't need good credit or collateral. If you've got revenue for 6 months, you manage your bank account responsibly, you can get approved. #3, MCA or merchant cash advance. Very similar to cash flow financing. Only need to be in business 6 months. Only need $5,000 a month in revenue to qualify. They're just looking at your credit card transactions, and you can get lent roughly about 15% of whatever your revenue is with revenue lending or in cash flow financing, or whatever your credit card transactions are for merchant cash advances. And that brings me to #4, which is invoice financing, factoring, AR financing. AR factoring goes by a lot of names, but AR financing lets you let your customers pay you on terms, and it gets you 90% of the money that they're due to pay you within 24 hours. So you don't have to wait for all their money to come in to get paid, and you make it convenient for them to pay you. And #5, microloans offered by SBA intermediaries and many other sources out there like Kiva. These loans go up to $50,000, are great for startups or people with challenged credit or don't have a lot of revenue yet, or the other things that lenders are looking for. And #6, free money, baby. Grants. We look at federal grants, we look at state grants, we look at local and community grants. And then on top of that, we are also looking at grants from private institutions, because they want to incentivize like things in their usually in their industry. So FedEx, for example, has grants, or Apple has grants for people that are innovating in those industries, because what they're really trying to do is motivate people to give them free ideas, of which they take and adopt and save all kinds of money. So paying somebody a grant to the winner, or paying a grant money to the winner, is a minor cost for them, getting all the free ingenuity of all of us that are actually applying for those grants. So that's it. The top 6 different ways to fund your business. If you want even more different ways, go to creditsuite.com/27. That's the number 27 for our guide on 27 killer ways to fund your business. Thanks for tuning in. Take care. Make sure you jump on these 6 different ways to fund your business. And if we can help you, we never charge you a dime of money to help you get financing. All you have to do is go to creditsuite.com/consult. That's creditsuite.com/consult. Our team can tell you all the funding you can get right now, and we can even take the steps to go and get you approved so you have the money you need to start and grow your business. Thanks for tuning in. If you got value, make sure you like and subscribe, and keep your eye out for our next training where we talk about more cool ways to get the money you need to start and grow.